Well, good morning. How's everybody doing? Let me know if you would that you can hear me loud and clear. That wasn't loud enough. I don't know what is. There you go, Brenda. Look, she's already up there. She just freaked out too. Morning, Kevin. I had to get my last cup of coffee for the day. Well, I shouldn't say last, but last one for the morning. So you should see that. I don't know if I can show that easily or not. No, it doesn't show up. Okay. Um, anyway, we'll get started. I'm gonna show you a picture or something, but that's all right. We'll just move and get moving so we can have a little bit of fun because I like to have fun here. So, but we have to do this. I'm not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. Seeing where things are at on that one. But here's the upcoming events, which before I forget, as some of you know, I'm a little ADD and sometimes get a little spacey and my mind's going 15 different directions. There is, Power Hour is, I'm looking at the message. I was told. Power Hour for Monday is canceled. We have a holiday coming up this next week. Morning, Helen. Juneteenth is Wednesday, and I'm trying to remember. Some of y'all probably know, and it's on one hand, it's embarrassing that I don't know. Is the market closed Wednesday or Monday? Is it closed Monday in observance of Juneteenth or Wednesday in the middle of the week, which would be weird? I remember seeing a message about it, but I just can't remember. So it is the middle of the week, Wednesday. This is kind of weird, but okay. So we get a day off in the middle of the week, which is unusual. I don't think there's any other holidays that they do that. Are there? Well, I guess there is. 4th of July is going to be the 4th. That's a Thursday this year. So I guess that'll be closed. And then Friday will probably be a half day. So Thanksgiving, that's true. It's the middle of the week. Tells you how much I pay attention. I mean, it doesn't. So the market's closed for a day. Okay, so I get a day off. It's not that big of a deal. And there's only what 6 or 7 a year. So yeah, Christmas too. I guess it depends on where they land. So no, you've embarrassed me enough, Trip. Thank you. Making me like, who is this guy? What is he? Does he not know what he's doing? I stay in my lane. I know what I'm doing about my stuff. And if I get an extra day off, cool. So, but here's what's coming up: the Cover Call Explorer Foundation class. Enter store. That is June 14th and 21st at 8 p.m. That is with you, right, Trip? I imagine it is, since you're doing the Cover Call Explorer. Inner Circle, June 17th, and monthly one is June 27th. And Mastermind Group, June 18th and June 25th. Trading You is June 20th. All these are 8 p.m. Eastern time. You can see right there on your screen. Monster Market Movers. Then the free online workshops. No Power Hour. Trading Coaches Playbook. Well, that should still be on for next week. Power Option Plays Monday and Thursday. Cover Call Explorer with Trip on Thursday. And then E-Mini Think Tank is Monday, Wednesday, and Friday. And then you can find us on all the social media platforms. And then if you're not familiar with me, these are the 3 I have. One more soon to be coming, starting Monday. But Patterns that Flash, that's I know some of you have been in there recently. We've been doing some promos for that. It's all about patterns and recognizing patterns and how to trade the patterns and foundations of technical analysis. So if you're either new or you are have been doing this for a while, but you're not certain that your technical analysis is maybe where you want it to be or think it should be, grab that for a quarter and check it out. Grab the 2-week trial. Thank you, Andrew. There's a link in there. You get a 2-week trial. So, in fact, what is today? The 14th? Yeah, there's still a. Can we cheat and give that out here? The promo. It saves you $30 on a quarterly subscription. Right? If you go to subscribe to it, there's the promo code. I'm just going to give it out. If I get in trouble, I will. The promo code is patterns. So if you go subscribe to Patterns in the Flash, there should be a promo code box. Put in patterns. I think it's all lowercase. That's good. That's good till the 16th, which I think is what, Monday, right? What is today anyway? The 14th? I'll tell you, I don't pay that close attention. I don't need to. Right? I get up in the morning and trade. It doesn't matter what day it is, does it? It's almost like, I mean, even though I'm not retired, it's almost like being retired. I don't have to know what day it is. It's just as long as the market's open, I'm content. Yeah, 14th. So Sunday, it actually expires Sunday. Awesome there. Thank you, Andrew. There's the offer that's been out there for a little while. We've had some promos for these. So again, it saves you $30 a quarter. So, but you get a 2-week trial. No, I'm not, Brenda. I'm perfectly on track. So yeah, go take the trial. Do the quizzes. If you pass the quizzes, maybe you don't need it. If you don't, keep it. Weekly Whispers. This is another quarterly subscription, which is it's based on my research. We launched it at the beginning of last year. I go every Thursday, like I did last night or afternoon, whenever I get to it, and I go do my research. I find patterns. I analyze the patterns. I narrow it down to usually about 20 or 30 candidates for the week, and that's all I watch for the week. So I only go hunting once a week. I don't do it every single day. It's just too time intensive, and it takes too much. And the patterns don't change that much. Usually about a third to half of the ones we have every week are rollovers from the next week, where they're patterns that are developing that we're watching to see if they play out and break out of the patterns. So it's basically me just going through my analysis, giving you my big picture view, what I think the market's overall doing, what the economy I think looks like, bullish, bearish, and then we review last week, and then we look at candidates coming up for this week, and then at the end we look at some options. So, and I've started splitting those up into sections. So if you don't care about my overall perspective, you just want to go to the patterns for the week, you can jump to that section. It's 15 to 30 minutes, depending on how many candidates there are. And so it's up to you. You can, that's why I've split it up so that people can have a little more control and pick and choose which sections they want to watch. So, and then if you want to come back and review it, it's easier too. So Juneteenth. That's a new, I think last year was the last year or the year before was the first time they've made that a holiday where the market was closed. So yeah, I think it's the 19th, which is Wednesday. So, and then small accounts, big returns is a pre-recorded class I did, I don't know, a couple years ago, I think, about if you're starting with a smaller account, how to manage that and how to work with it. So in fact, what we're going to talk about today will also, well, this is going to help no matter what size account you're trading with. Okay. And some of you are going to be like, oh, this again. But I'm going to pound this in because it doesn't seem like it was that long ago, but I think it was probably 6 months or 9 months ago that we talked about this. But there's only one person that comes in here and says, yeah, I implemented that and it changed the way I trade. And until at least a third, if not half of you come in and say I did this and it's changed the way I trade, I'm going to keep hammering it. I hit it all the time because it's that important. It did. It completely changed the way I trade too. So it's from my own personal experience of understanding what it was like to go from what I thought was solid trading to now looking back on it, I was winging it. So, but the key was several keys to trading, right? You probably don't just have one key on your key ring. You got a few of them, right? One to your car, one to your house, one to this, one to that. So there are several keys, but some are more important than others, right? We're going to talk about odds today because odds is super critical for everything. But let me ask this question. I know most of you know the answer. Some of you may not. How many want to have a 95% win rate? I don't like the term win, but that's why I put it in parentheses. Right? This isn't about winning and losing. It's about odds. Oh, I need coffee, Brenda. It's because I was up late last night doing my my videos. It took longer than normal yesterday, so I did not get a whole lot of sleep last night. So yes, I need coffee, and this is only cup number 3. Normally, after a bad night, I'd be needing 4 or 5. Yeah, 3 is normal. 3 is normal for me. I know. Anyway, anybody like 95%? Usually somebody says, yeah, I love it. I want it. Okay. But now we change the dynamic. 95 of those wins, you made $1 per trade. Oh, there you go, Trip. It depends. So 95 wins, you win $1 per trade, and you have 5 losers where you lose. That's supposed to be $100 a trade, not $500 a trade. Yeah, that's supposed to be 100. That's wrong. It'd be either way. Either way, it's ugly. No matter how you slice it. My typo, bad math, whatever you want to call it. You're still losing money, right? This huge percentage of wins doesn't mean anything. And I used to think when I started back in 2000, I remember thinking, if I can get to 70, 80% right, I'll make a fortune. And I remember thinking, you've got to be right on at least more than half of your trades. You can't, if you're wrong more than half the time, you're going to lose money. It's not possible. And it took me quite a while to finally realize that that's not true. It's not true at all. It's not even close, right? Nobody wants a 95% win rate if you're still losing money, right? And that's how a lot of us start off. You start off by taking huge losses because you don't take a stop, because you don't understand yet the emotions of trading. You don't understand that, it's not about making a whole bunch of little wins. It's about a whole bunch of little losses and big wins. Letting your winners run, making big profits on a small percentage of your trades, and cutting your losers short. You've probably all heard that, right? Let the trend be your friend. Cut your losers short, let your winners run. There's all these mantras that we all have, right? Well, to cut your losers short and let your winners run is really hard for us in the beginning, because we're raised for the most part in this mindset that you don't want to be a loser. So if you lose, that's bad. So we come in with this mindset that losing money is bad and I don't want to do it. And so you either don't put a stop in there, or you move your stop, or you get rid of your stop because you don't want to take a loss. And then by the time you actually take a loss, it's gotten so bad that now you have this monster loser. And then there's this idiotic mantra that came out at some point that somebody came up with that said, you can't go broke making a profit. Oh, yes, you can. You just saw it. Look at the numbers. If you take a little $1,000 winner, $1,000 winner, $1,000 winner, and you have a $10,000 loss, you're going to be broke pretty quick. The numbers don't work, right? But that's the way a lot of us start out, because we don't have the mindset. We don't have the emotional control. We don't have that spot where we realize that taking a loss is okay. Taking a loss is necessary. It's actually a good thing. When you get to a place where you're excited that you took a loss, that's when you've arrived. When you go, okay, cool, I just got out, took a hit, no big deal. Good, I'm happy. Now I can take my capital that I have left over and go do something different that might yield a big profit. It's literally a mindset shift. And I was raised the same way. And that's why I had the same challenges, same hurdles that everybody has. Most of us do. You grow up playing sports, right? Don't ever quit, fight to the end, fight to the end. Well, in trading, that, from a big picture perspective, that's a great attitude. But if you get it down to a granular look at each single trade and treat each individual trade that way, that will create financial death. And I use baseball a ton because it's such, batting is such a great analogy, right? If a batter went up and expected to get a hit every single time, they're going to quit the game quickly, right? They're not going to play very long, because that's not possible. You got this little tiny ball coming at you at 70, 80, 90, 100 miles an hour. You got this bat that you got to get around and hit it. And it's got to be in this. I mean, it's the odds of getting a hit are not spectacular. But when you look at baseball, the best of the best players get a hit 30% of the time. That's it. 3 out of 10. 3 out of 10 times they step to the plate. Those are the best of the best. The mediocre ones get, 225, 250. The average players are 225, 250. They're not even 25%. Yet the guys that are making, that are hitting 225, 250 are getting, league minimum, maybe 800, 900,000 a year. The guys that are hitting 300, they're getting 7 figures. What if that same concept applied to trading? What if you had that same mindset where that you step in the batter's box and that 7 out of 10 times you're not going to get a hit, but 3 out of 10 times you are, and you're still going to make a healthy salary. Well, not a salary. And this is the business, right? That is too, but I guess they're probably the same way. But what if you shifted to that mindset and you knew that every time you step into the batter's box and you swing the bat, you're going to walk back to the dugout without a hit 7 out of 10. Could you relax? And when you strike out, or you ground out, or you fly out, can you just go back to the dugout and no big deal. Take off your batter's hat, you get your glove and your hat, and you go back in the field and you play defense, right? That's what the pros do. And one of the big ways they do that is by bouncing back from defeat, right? If you go out and you strike out, it's not fun, but they just walk back to the dugout. It's not a big deal to them, right? They don't freak out. I mean, sometimes they do, right? They throw their bat or freak out. And if it's a highly intense situation, sometimes they do. But the vast majority of the time, they strike out, they just walk back to the dugout. All right, no big deal. But why don't we do that in trading? Why do we get so upset, so angry, and oh my gosh, I can't believe I lost on this trade? If you're looking at the long game and you're looking at the big picture, then one little trade should be nothing to you. It's just one more at bat. And you got a whole season. You got 600 or 700 at bats. You got 4 or 5 at bats per game, 160 games a year. It's just one more at bat. And you struck out this time. So what? Grab your glove, get your hat, and get back on the field. Go play defense. A little redundant there, huh? Would you be able to stay calm, cool, and collected if you knew that less than 50% rightness? I don't know if that's a word or not, but it sounded cool, so I put it in here. What if you still were profitable and you knew you didn't have to be right more than half the time? And some people are like, that doesn't make sense. I know some of you right now are like, I'm going to show you. I'm going to literally show you. And we're going to, it literally, the people that haven't seen this, I know quite a few of you have, but if you haven't seen this, it blows your mind. But then you know what happens? Nobody still does anything with it. Oh, that was cool. That was interesting. That was really cool. And then they come back and like, I don't know what I'm doing wrong. Okay. One of the keys to long-term consistent success in trading is the ability to manage and control your emotions. Okay. Not eliminate. Anytime I hear anybody say eliminate your emotions from trading, I say run. Because they don't understand trading at a deep level that allows you to. You cannot eliminate emotion. It's not going to happen. That's like saying don't ever get upset in life. Don't ever let your spouse make you angry. Don't ever feel anything. Don't be sad. Don't be depressed. Don't be angry. Don't be disappointed. Don't feel guilty. All those emotions are there. They're never going to go away. You're going to experience it your entire life. It's not a matter of eliminating them. It's a matter of learning to manage and control them. And we do that in our regular life, but for some reason we don't focus on it in trading. And that is one of the main keys. This is one of the most important keys to trading, is learning to manage your emotions. And what I'm going to show you today is one of those massive things that will. And before I get too far, and I forget to mention this, this is, for the most part, I mean, you can conceptually take it into other non-directional type of trading, but for the most part, this is for directional trading, right? If you're trading, if you're buying calls or puts, if you're buying stock, if you're doing spreads, cover calls, I mean, you can use it. It just has to be tweaked a little bit, right? The concept is spectacular. You just have to tweak the concept for certain strategies, right? But again, this one simple concept gets you to a calm, cool, collective space, because that should be your ultimate goal. If all you're focused on is money with regards to trading and how much money you can make, then long-term, you're probably not going to succeed. The goal in trading is to get to a calm, cool, collective space. Should be. Because when you make irrational, emotional decisions in trading, how many of you have ever done that? And you're like, oh, that was stupid. And a huge percentage of the time, if not the vast majority of the time, they're bad decisions. But if you can get yourself to a calm, cool, collected space, then your decisions will be from that calm, cool, collected space, and they will be good decisions most of the time. You're still going to make mistakes. You're human, right? But in my opinion, the goal in trading should be get to that place where you're not worried about your trades. You're just letting them do their thing, right? Exactly true. Find a way to mitigate emotions, but can't remove them. Yeah. Like I said, it's like living life without emotion. You know, and if you have a spouse, they ever do something, you know, they leave the toothpaste cap off. What do? You lose your mind, right? Your husband doesn't pick up his underwear. I've heard that story a million times from my parents. My dad always complains. He's like, I had to pay a counselor $100. I kept telling her, well, just leave him there. I'll get him eventually. And it would drive her nuts. She'd pick him up, throw him in the hamper, and just leave him there. And then they go to a counselor. The counselor says, well, just leave him there. Let him get him when he gets to it. Why is it bothering you? He says, I kept telling her this, that I had to pay a counselor $100 to tell her the same thing I've been telling her And then she finally just chilled out. She just left it there. So I don't know why I've heard that story so many times, but yeah, I'm sure some of you can relate to that. I know I can. Um, that's a little redundant too. But a lot of this, I mean, really the focus is, and this is one thing, and I had learned risk reward early on. But I didn't see it from this perspective. Conceptually, I didn't understand it this way. I understood what it was and I understood what it meant, what a risk reward was. But I didn't recognize the ability to use it to manage and control my emotions to get me to that calm, cool, collected place. But if you knew 10, let's say you do all 10 trades, say you go pull the trigger on 10 different trades, and you have your plan set up, and you have 3-to-1 in place, and you put them all on, you put the stops on everything, and now you just sit back and go, you know what? I don't need to worry about these. I only need 3 of them to work out. If 3 of them go and do what I think they're going to do, what I expect them to do, I should be golden. Right? If 7 go against me and I get stopped out, so be it. The other 3 should make up for the losers, right? Obviously, there's some variables there. I mean, if you did, 3 trades that have $20 of potential loss, the other ones have, $2 of potential gain. So, I mean, obviously, there's not a rock solid way to say every time, but generally speaking, and I'm using 10, but if you amortize it out over 10, 100 or 200 or 1,000 trades, then the numbers all work, right? And this question comes from a place because this is what I experienced, right? I understood risk reward, and then all of a sudden I saw it from this perspective, going, wait a minute, you mean I only have to be right 2.5, 3, 4 times? I was like, oh. So what I started doing was creating a plan on some of my charts and trades, and one day I ended up having 4 of them trigger. I think I had 2 or 3 other trades on over here. And then I had these 4 that I had implemented risk reward. I had a plan, I had a stop, I had a target, and I had an entry point based on 3-to-1 risk reward. And I realized when I'm sitting going, I don't care about these 4 trades over here. The plan's in place, the orders are sitting there. I'm not worried about any of these. If 3 of them go against me and 1 of them goes in my favor, I should be fine. I'm going to be break even, maybe up a little bit, maybe down a little tiny bit, but I'll be fine. I'm not going to get hit hard or big because here's the plan. And obviously gaps can change that, but those don't happen very often. So I was having this massive contrast moment where I'm going, I'm totally calm, cool, and collected about these 4 trades over here. And these 2 or 3 or 4 I have over here, I'm still nervous and anxious about. And I thought I was a solid trader at the time. And it's not that I wasn't, but I wasn't in that calm, cool, collected place. I was still nervous and anxious about these trades. Still trying to manage them and control them every single time. These ones, I just let them go. Well, who cares? Whatever happens, happens. I think 2 of them went in my favor and 2 went against me. So it ended up good. And I'm like, wow, this is a whole different experience. It's a whole different ballgame. It's literally nothing more than just risk reward. And I imagine you're all familiar with it. If there's anybody not familiar with it, let me know. Well, I'm going to show you how the numbers work. And this is kind of conceptually, but we'll go and look at the real numbers and how they actually work, right? So we're going to do a series of trades, right? 7 different trades. Maybe you've seen this. I've shown this a lot, right? And you're either going to make $3 or lose $1. And then we keep track of the percentage of winners versus losers, right? A win rate. So the first trade goes against you. You're down $1, right? You're negative 100%, 0 for 1. Trade number 2, same result. You're down in net $2. Trade number 3 goes in your favor. Like, cool. Made $3. Now I'm up $1. 33% though. Batting average is 330, but you're still profitable, huh? Excuse me. Trade number 4 goes against you, so you're back to break even. Trade 5, 6, both go against you. So you're down back negative $2. But trade number 7 goes in your favor. $3 profit. Now, net-wise, you're back up $1. Yet you're only 28.5% accurate. 2 out of 7 trades go in your favor. 5 go against you. And you're still profitable. See, if you go into trades knowing this, knowing that you don't have to be right that often, because the risk reward is on your side, that allows you to just let it go. As Elsa would say. Is it Elsa? Let it go. I can't sing. I'm not even going to try. Just let them do their thing, right? That's all that you have to do is just make sure that the odds are on your side. Now, this is obviously kind of a pretty basic example. So let's go give some real world and play a little bit. So there is my list. That's so skewed right now. You want to look at that. Oh, I got to have two of these. That's right. So here's my risk reward calculator, which I don't use very much anymore. You see, it's 3-1. So these are all, and so these are my candidates for this week for my weekly whispers, right? I went and I just pulled, there's 33 of them and I only have 20 slots here. So I took the numbers from these. I don't know if there's that. Yeah, TTD's on there. So TTD, the one, you can see the chart there on the right. You can see that, right? Okay, good. So the very bottom one on this list right there, number 36 is that one, right? You see the numbers I put in 90-12 is the entry point. The target is 80-34, the dark green line, 80-34. So the entry is 87-68. Oh, no, wait, I'm sorry. Wait, this is not right. I punched in the number wrong. Oh my gosh, I hope I didn't do these all wrong. 93-38. 93-38 is the stop. The entry is, or the target is 80-34. That's still right. So 90-12. So this is the entry. You see the 93-38, that's the stop. Let me open the chart up. So you can see the stop, the entry, and then this is 3-1 target, the green line, the dark green line. Holy cow, I hope I didn't do those other ones wrong. Actually, what doesn't really matter. Let's see what this one is. I think, did I put Roku in? Holy cow, I did. I think I did these. I did these wrong. You know what? It really, honestly, it doesn't matter. I put in the numbers that weren't quite accurate, but it really doesn't matter. This is the beauty. I'm going to show you this, even though I just realized that I kind of sort of messed this up. So I put the entry point in as the stop instead of the target, and I'm not going to take the time to change these because honestly, it really doesn't matter because the reality is the numbers are still the numbers. They're still the downside. You see the downside number right there, and then the upside. There's 3 times as much upside as there is downside. So no matter what numbers you put in here, they're all going to be the same. And then we come over to Google and find a coin flipper. There's a coin flipper. I know some of you are like, ah, really? Yep. So we're going to randomly just flip a coin, have this thing. You know what? It actually plays out, Brent. It's a good thing. Good we get to see you do it right. Here's the beauty. Even though I'm doing it wrong, it's not necessarily wrong, but even being wrong is still going to work out right. Which is kind of the point of this conversation is even if you're wrong a lot, you can still come out right. So yeah, I punched in the numbers wrong, but again, the numbers are still, it's still gonna play out the way it should, right? Because it doesn't matter what number you put in here because the upside in this one you see is 216. What's 72? Whoops, that's not what I put. 0.72 times 3, 216. So I have 72 cents of risk, $2.16 of upside. I have 3 times as much upside as I have risk. So regardless of my minor mistake, the numbers still work exactly the same. So that's the beauty. You can be wrong in the trade and still be right long term. So I don't necessarily like the term right or wrong, but so we're just gonna do this flipping thing. So we want heads is gonna be a win. I'm gonna keep it easy. That's what I've done before. Heads is a win, tails is a loss. So we're gonna take this, the downside or the upside, whatever it is, and put it in this number and it'll calculate out how we ultimately end up. I'm gonna get rid of that win-loss down there at the bottom so you can't cheat and see it ahead of time. So let's flip it. Heads is a winner. Heads is a winner. Okay, the first one, there's a winner, $2.16. Flip it again. That's tails, so this one's a loser. 1.35. Now I'm paranoid that I'm going to put one of these in wrong. So if I do, somebody yell at me. It's fine. It's fine. When I make a boo-boo like that, I start to get paranoid. Like, I don't want to do it again. So this is a winner, 117 on that one. Heads is another winner. Oh, that's a good one. Right? 1053. It's always good when you hit the big ones, right? Tails. That's a kind of big one though too, but it's losers only $1.76. Should we look at the numbers? No, we don't. We're not going to look till the end. Tails, that's a loser. Ouch. That's a big loser. 317 versus 952. Would have been nice to hit a profit on that one. Heads. That's a winner, 124. Yeah, it's a little bit tedious. I'm a little there's a winner, 326. Whoops. You can tell I talk fast and this is a little like but you'll see. So that's a loser, 0.83. Tails is a loser. Has winner, 518. Oops. I guess I should do that flip. Okay, that's tails. I'm going to flip it before we come back. That'll speed it up. That's a loser. Tails 02. Heads. Oh, there's another big winner, which I know it's like, it's going to skew it. But you can see, this is randomly. I'm not doing anything here. Heads, that's another winner. 520. Heads, another winner, 254. That's a small winner, but we'll take it, right? Heads is another winner, 225. Tails, that's a loser, 0.59. Tails. Ow, there's a big one. But there's a good sized winner right behind it. Two more, and we'll see what they look like. Heads and 2.43. That's a little winner. And then heads, that's a big winner. Oh, that's going to be huge. So a lot of winners, right? And if we scroll down here and see, yes, 13 winners. That was a 65% win rate. But there's the beauty. Look at the profitability, 54. It's huge, right? You made $66. You gave back 12. That's massive. Okay. This is not the way it's supposed to work out. I want it to come in below 50%. So we're going to do this again. I just figured out how to get it going quicker, at least. So we can flip while we're punching these numbers in. Tails, there's a loser, 0.72. Whoops, I didn't do what I just said. Tails, another loser, 0.35. Heads. Ooh, 117. Woo! Tails, that's a loser. Tails, 0.76. Come on. 952. 1.24. Heads, 326. Heads again. Why are we getting so many heads? I want more tails. We could cheat, I guess, and go manually put them in there if we wanted to. What's going on here? You know what? If this happens, I'm going to put like the last 6 in there. Another heads. Whoops. What is going on here? Why is this thing hitting heads so much? We should go to this random one. There's tails. How many do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So, we're 60% right now. You know, I want to make the rest of these losers. Whoops. There's the point right there, Brenda. And we'll even do this. I'm gonna take this big winner out and make it a loser. 413. There's a 40% win rate. 40% win rate, and you're still profitable. So, I mean, obviously the coin flipper we were actually at 50-50, but I wanted it to be under 50-50 because even with this and even taking out that big winner, right? There's some of these, and this is where, the numbers, if you do it on a short term over 10, if you have these big winners and these two big winners hit, you could lose on the rest of them. You get to 1240 and then 1053. You get both of those two flip a winner, and the rest of them have losers. You're still going to come out profitable, right? You'd be 2 out of 20. So there is some variance there. But when you look long term over 100, 200, 300, and if you do this consistently, but the beauty is, there's the thing, is even when we take those, we had one big winner. The rest of these are all pretty moderate, right? But when you have 6, we have 12 losers, 8 winners, 40%, and you still come out ahead. So you don't have to be right more than half the time. And that's the beauty of this, is utilizing risk reward. When you implement this plan and you stick to it, obviously you have to stick to your risk reward. If you let one go out and it blows you out, then you're going to have a problem. But as long as you implement a risk reward and you stick to it, then in the end, you can be wrong 60, 70% of the time and still be profitable. How to get the flipper to match the calculator? I don't know what you mean by that. I just randomly pulled flipper from Google. You just put in coin flipper. I mean, you can do this yourself if you want. Go throw together some numbers. Just put some numbers on paper and go play with it yourself. But going back to your other question, what's the purpose of the exercise? The purpose is so you can recognize and see that with real numbers in real life, when you just flip a coin, you get 50-50 chance of winning or losing, which is exactly what trading is, right? We don't know what a stock's going to do. None of us have a crystal ball. If you do, let me know. And if it's can prove to be right, then great. But I don't. Every single time you get in a trade, it's literally the flip of a coin. But some of us get stuck in that mindset that, we can analyze the chart good enough to be able to be right more often than we're wrong. And you really technically can't. Can you analyze the chart and get an idea of what may be coming next and put the odds on your side? Yes. That is the point of this exercise, is when you put the odds on your side, because you learn to analyze the chart well, and you can say, okay, based on this pattern and this and the support level, the role reversal, whatever it is, whatever setup you have, then, okay, you've got an analysis that says it's probably going to do this next. But we still don't know. We still don't have that crystal ball. So it literally, even though we analyze things, and if you get good at analyzing, then you can be right. But it's still about odds. It's still a coin flip. No matter how good you get at analyzing the charts, you are still flipping a coin. And it took me a long time to realize that even though I mastered reading charts, it's still a coin flip. And so no matter how good you get at reading charts, how good you get at a particular strategy, whatever it is you're doing, you're still flipping a coin. And if you have the odds on your side, and you know that when you flip that coin, you know that the odds are on your side, and you know you don't have to be right more than half the time. You can be right 30% of the time, 35, 40% of the time. And you're still going to come out ahead in the long term. It's a total mind shift. I've done this at least once, if not 2 other times. And the only person that ever comes in and says that it totally changed the way I trade is Will. He's not here. Because once you do it, most people just look at it and go, oh, that's interesting. And that's what I did too. I was like, risk reward, I knew what it was, but I hadn't seen it like this. And then I saw it, and I go, wait a minute. And it caught my attention. And I go, I'm going to try that. And then I tried it, and I went, oh, wow. That's where, like I said before, the contrast between here's the trades I have the plan on, here's the trades I have risk reward implemented on. I'm not worried about these. It was a totally different emotional state for these ones over here versus these ones over here. And I think maybe until you have that contrast and you recognize where it takes you emotionally when you implement this on every one of your trades, I think until you experience that firsthand, you don't see it. I mean, sure, you might see it conceptually. And you probably all experienced that in real life things, right? Where you understand something conceptually. I mean, well, as kids, we understand things, and then we get older and older, and you experience things in life, and you go, oh, that's what my mom meant, or that's what my dad meant. Oh, now I get it, right? Because you've seen it firsthand. That's what this is. You see it, you might go, oh, that's cool. Oh, I can be wrong more often, right? Oh, neat. That's cool. And then you go back to do what you're doing. But until you go and actually do this and recognize and see what it does emotionally for your trading, then nothing changes, right? I mean, that's the important thing. You've got to implement this and start doing it. So, oh, Brenda. Oh, yeah. You just have to put a column on there and then just you just add a column. I just threw this in there, just win loss, and then at the end down here it's a calculator, right? So you just sum up the whole column, sum up the whole column. It's just some Excel calculator things. That's about all I can do with Excel is do like adding columns, do like these basic math functions. That's it. So you could do that. You could put it over there if you want to. So factoring the going sideways, I'm not sure what you mean by that, Les. Are you talking about option deterioration? I'm assuming that's what you mean, but I'm not 100% certain. So, oh, yeah, this is Google Sheets too. I don't know if you have, do you have Excel? There's this little thing right here, functions. So you can do this. If you hit functions, it'll give you things sum. So if you want to sum up a whole column, the easiest thing to do is you go YouTube, like doing a certain thing in Excel. How do I add up a column in Excel? Go on to YouTube and it'll show you. There should be videos that'll be quick and easy to show you how to do that. It's not super difficult. And once you know how to do it, you'll do more of it. Actually, it's not really that complicated. So, and a lot of times it'll do it for you, right? Even though that's already there. A lot of times, if you come down here and you hit this one and you say summit, it'll actually. So you can highlight this whole column just like that, and then it shows 14 through 36, and it just adds it all up for you. It's really simple, actually. So, and you'll have some fun with it once you learn it. So, yeah, I think I know what you mean, Les, which is kind of outside of the scope of this example. So, and I understand that. So, but getting back to the larger point is if you know that you don't have to be right that often and you'll still come out ahead, you get to that calm, cool, collective space. And that's what I think, in my opinion, that should be your main goal is to get to a place because when we're not in a calm, cool, collective space and you're anxious, you're nervous about your trades, then that's when we make emotional decisions. And oftentimes those emotional decisions turn out bad. So if you can get yourself to that calm, cool, collective space, now the decisions you make when a trade is doing something either in your favor or against you, then you are still calm, cool, and collected, and you're making good decisions then, right? That's where we make the best decisions when we're calm, cool, and collected. And yes, I did say if the stock's going in your favor, because we still make stupid emotional decisions. Like, oh, it's going to keep going. It's going to keep going. And you stay in. And the next day it gaps up against you. And you're like, you're freaking out. Well, if it gets back there, then I'll get out. Right. You have all these rationalizations as to why you're doing this. It's like there's other solutions to that too, but we get greedy, right? It starts moving in our favor. Now we want more. We want more. We want more. Give us more profit. Give us more profit. And you've got to work against that too. It's not just when stocks are going against you. It's not just the fear factor of losing. It's the fear factor of missing out though too, right? There's the old FOMO. And that's where, when things are going our direction, we get all excited. We're making money. And then you make stupid decisions because your emotions take over. So you got to balance it out on both sides of the equation. It's not just the losing side. It's also on the winning side. Because we probably all experienced that, right? Where you've gotten into a trade, it's going in your favor, like, woo. And then you get so excited about it, you forget to make good, rational decisions. Then you make dumb decisions, and then it costs you. So trading is all really, it's about odds. It's about putting the odds on your side. And by doing that, that allows you to get to that calm, cool, collected place where you can make good, solid, rational decisions on all of your trades, hopefully. You're still going to make mistakes, right? Even after almost 25 years, I still make mistakes. The key is to minimizing those mistakes. I used to make a lot of mistakes. Now it's few and far between. But it almost always comes back to when I do, it's something that emotions get me. It's like, oh, it's moving, get in. Like, And I recognize that now, and like, just chill out. It's probably not going to keep going without you. And if it does, then so be it. It's better to miss it than it is to get in and have it turn around and you get crushed, right? I'm busy. Can't you see that I'm working? She's going to come sit on the mouse. Exactly what she did last night. That's the picture I was going to show you. There she is. She's hitting the keyboard now. Such a goofball. Leave her alone. She's interrupting me. She literally just laid down on my hand as I'm trying to work the mouse. She did that last night as I was doing my analysis. That's why I got a picture of it. She laid down and put her paw over my wrist, which is almost what she's doing now. I know. I can't kick her off. She's too cute. Um, uh, I'm not sure what you're asking exactly, Brenda, but the best thing I can tell you is yeah, go on YouTube and look up Excel stuff. There's millions of videos out there about Excel because a ton of people use it. And most of the basic stuff like that, it'll take you just a few minutes to figure it out. It's pretty simple. They'll show you. I usually do that, and then I'll follow along. Like if I'm trying to learn something, I go there and look for a solution on there first because there's somebody that is out there explaining it. So yeah, that's necessary sometimes, Scott. Scott says sometimes I just have to say to myself on a winning trade that I made a profit and I'm satisfied. True, very true. And this is a mindset game. That's really what it is. I mean, the vast majority of it is all based on managing your mind, managing your head. And that's where, implementing stuff like this, the risk reward, not only, the biggest thing for me that shifted was knowing this, that I can be right only 35, 40% of the time and still be profitable. And when I had those 4 trades I put on, I didn't care what happened with them. I literally was just totally chill about them. I'm like, oh, whatever. Great. If one goes in my favor, it was kind of mind boggling. And that's when I shifted and I went, okay, I'm not doing this. I'm not placing a trade ever again unless I have at least 3-1. It took me a while to get to that place where I did, but now I don't. I won't even get into it. If it goes outside of the range, I mean, there's a couple times you make an exception. It's 20 cents beyond your entry point, and there's a 10-point range. Sure, you make those minor exceptions, but if it goes too far, I mean, I'll just I can't even move my hand, the mouse. I'm going to shut that down. Whoops, I shut everything down. That's all right. There's 1 or 2 examples I can give you here that I think on here. Really? Yeah, well, there's one right there. No, I did catch that actually. GE's one that I missed yesterday. So I didn't have an order sitting on there. And by the time I saw it, it was all the way down here at like 154 and change. It was at the low of the day. And I was like, that's too far. Even though there's $13 of potential, I missed it by $2 or $3. So that throws the risk reward so out of whack. I'm not willing to do it. And if I miss the trade, so be it. I mean, I've got 34 other candidates on the screen and other ones. This one triggered yesterday, I think it was, or this morning. I can't remember. COP triggered this morning. This one, I don't know if this triggered or not. Well, and actually, nope, 2101 is the low. I have an order sitting out there at 2097. So if it hits it with the target down here, the dark green is the 3-1 target. I changed this recently. This is the tool that you draw. All you do is put the stop and move the entry to where you want it. And it puts the 3-1 is dark green, 1-1 is the first one, that kind of yellow. The bright green is 2-1, and the orange is 4-1. So I just saw your note to let her trade. She's trying. She's watching the mouse right now on the screen as I move it around. D-Dog, this one triggered this morning. Excuse me. Disney. Oh, this is beautiful. I love the looks of this. Or it's just bouncing back a little bit. It's 99.60 right now, but it's breaking below 100. It's breaking that support level. It triggered an entry this morning. IBM also triggered an entry this morning. So I just put them in and let them go and just let them do their thing. Pfizer triggered. All these ones I have checked are ones that all trigger. That's why you're seeing the top, because I usually check them and then put them at the top so I can keep a closer eye on them. The ones down here, I'm not as concerned about them because I didn't trigger a trade on them. So United Airlines, this one triggered big time. Ooh. Yeah, that triggered the entry this morning at some point. And it's already hit the 1-1. This might be something I need to pull a little bit of profit on. Scaling is another thing that is huge. And you've probably all heard me talk about it, right? So, and that's one of the reasons I like the new, I got the 1-1, 2-1, 3-1, 4-1. 3-1 is a target. Sometimes I make it 4-1 depending on the situation, but most of the time it's 3-1. And then if I get to the 1-to-1, now I can visually see where I'm at approximately, right? It gives me just a little bit cleaner idea of, okay, I'm at this place. Maybe I want to take a quarter of the position out. Maybe take it out, quarter of it here, quarter of it here, quarter of it here, and then trail the rest of it. There's a million different ways to do it, right? You can trail, you can trail it in 3 different pieces. You can put a trailer up here at, let's say you did 900 shares. You put a trailer, you put a stop in at 51.93, and then it comes down here and you move one trailer down to, on 300 shares down to 50.12. Then maybe you put another 300 shares really tight up at 49.48. So if it turns around and stops you out on 300 shares, you bank a little profit on 300. You got the other third of the position at break even. So if it continues to rally north again, then it breaks you, it gets you out break even on that half or that third. So you still got a third position there, which you may take a loss on, right? In this case, you're going to take about a $1.11 loss. Well, if you made a $1.11 on the other third, then you break even, right? So there's the beauty of it is that about right? Yeah, if you do that. There's a lot of different ways to do it. And for me, at least, it's always about how do I get the odds on my side where I can just relax and let the trade play out? Because most of you are probably all nervous during the trade, right? When the trade's going and you're in it, you're constantly watching it, or maybe you're not, but you're thinking about it, right? But let's take this situation. And this all plays out in a day. Using that, that's a perfect example. And again, there's a lot of different ways to do it. Say you pick up 1,000 shares. When it breaks, it hits 50.12. You put an order down here at 111. Let's say you take 400 of them out. Say put an order in to close out 400 at 111. And if it hits that, I've got 600 left, right? Put the stop on the other 300 at 50.12 at break even, and leave a stop on the other 3 back at 51.23. Because 51.23 to 49.11 is $1.11. That's why I like the 1-to-1. So now what I've just done is I banked a small profit on 400 shares. I got break even on 300 shares, and I've got a $1.11 risk on the other 300 shares. So now, almost no matter what happens, barring any kind of gap, you're at a break even position. So you just went from originally you're at 1,000 shares, and again, I'm just using shares to make them numbers easy. You got 1,100, basically $1,100 of risk. And in one day, you went from $1,100 of risk because it moved quick. It doesn't always do this, right? But you went from $1,100 of risk to 0 risk. Again, barring a gap, right? So in a day, it does exactly, you go from a huge risk, I guess it's not huge, it's 2%. But going from a decent risk to 0 risk is ideal. Because now if you're at 0 risk, what do? Just let it go. Let it do its thing. I don't care what happens. I'm not going to lose on this thing unless it gaps. How many of you could just relax then and just chill out? And maybe it takes 2 or 3 days to play out and get to this place. Let's see if there's anything that has done that. And again, there's a lot of different ways, you can work those numbers. Add the spiders and the Qs to my list. I look at the SPX and the NASDAQ pretty much on a daily basis. So, and they're basically the same thing. So I don't trade the ETFs. I know some people do. That's all they trade. See, some of these have all triggered. IBM's actually backing up against Disney, just barely triggered. See, that's the only one out of all these. Okay, COP, you could be in the same or close to. I don't know if it actually hit that spot, but it got close. By the end of the day, it might be there. So there's, how many of those are marked? There's BKR. That's not all the way there, but we have 10. Okay, so that's 9 stocks that are checked right there that we just looked at. And there's 3 of them that have gotten close to the 1-to-1. So if 3 of these get to the 1-to-1 and you do that, you pull out a third of the position, or maybe even more. And then you move a stop on half your position to the break-even place, and the other half you leave where it was, or however you adjust it. You can adjust the stops to be, if it backs up against you and it doesn't gap through it, then you get a profit. I have those sometimes, and a lot of it depends on how far it moves, right? If it moves down to the 2-to-1, the 47.90, I'm moving the stop down here to wherever it makes sense on the chart. And then you just adjust it down as it goes. And maybe you put an order down here to take out a third of it. Maybe UAL keeps coming and, okay, well, it's here. I'm going to move the stop on this half down to here to the 49.01 and move this one down to break even. You can move them both down here. You can move the whole stop to the rest of it here. The further it goes, the tighter I make the stop, generally speaking. No, good question. Is the stop based on the calculator? Yes and no. I use the calculator as a gauge, right? Especially now having the 3-to-1, all the 1-to-1, 2-to-1, 3-to-1, 4-to-1 on there. That just gives me a visual of where the trade's at, generally speaking. I base the entry on the analysis of the chart. Is it a strong move? Is it a weak move? Is it, I mean, if it's dropping right now, I mean, we're what, almost 10 o'clock? So we're basically halfway through the market. Well, if this thing just gets blitzed and continues to drop, and we already have, if that volume number is accurate, we already have pretty solid volume. So if there's lots of momentum and it really looks like it's going to keep going and there's no reason for it to bounce back, then I'm going to leave more of the trade on. If this thing closes out and say the volume was really light for the day, sure, the bears won the day, but they didn't do it with a whole lot of excitement. So there I might pull out half the position instead of 200 shares. So the amount that I take out, the amount and how I move my stop and where I adjust the trade, because that's what all you're doing is adjusting the trade based on what it's doing. So you have your original analysis. We have a nice little head and shoulders there, right? It's actually beautiful. It's about as textbook as it gets. Today we're breaking the neckline and it's playing out beautifully. And if it keeps going, I might leave the whole thing. I don't very often do that, especially when it moves fast like this, because it very easily could snap back. I mean, you could have, move that out of the way. I mean, if you get, well, you get a cascade of like 7 or 8 days, this kind of a day is bound to happen. But this is only 2 down days, and today's a big day, so we could have a snapback. But I adjust the plan according to the analysis of what the chart looks like. Is it really strong? Is it moving in my direction? I might take 0% of it out. I might take 20% out. I might take, if it's weak, if it's making a move in my direction, I've got some profit, but it's like, I'm not very confident in that move. I might take half of it out. So the adjustment to the plan is 100% purely based off of what the action is, what the price action is. What's the move look like? And does it look like it's going to keep going? Because that's how you get to those places where you have those home runs, right? You're stepping into the batter's box, right? And you get however many swings you get, right? You might only get 3 pitches, 3 strikes, you're out. You might get 8 or 10 or 15 pitches at bat. And you adjust the plan accordingly, right? You step into the batter's box, your first pitch, comes right down the pipe, 120-mile-an-hour fastball. That might be a little fast, but you don't swing at it. It's like, okay. Well, now what do? You're behind in the count. Now you adjust your plan a little bit. Okay, here's the pitch that's probably going to come next, based on the fact that he's ahead. Now the pitcher's ahead in the count, and I'm behind. Next pitch is a strike. You swing at it, you miss. Now you're really behind. One more pitch, and you're out. So you adjust the plan. Now you're going to go, okay, now I'm going to analyze it and say, okay, here's the pitch he's probably going to throw a curveball now. I got 2 fastballs in a row. Here comes a curve or a slider, whatever it is they pitch, right? It's one reason I use, I mean, not only I played baseball as a kid, so I'm familiar with the sport. Most of you probably are too. That's one reason I use it, but it's an easy way to analyze, and trading is not much different. You analyze the situation, and what does it look like? Am I ahead in the count? Am I behind in the count? What pitch might be coming next, and how do I adjust my plan based on that analysis? Clear as mud? But really, ultimately, it all comes down to managing your emotions. Analyzing the charts is that's the superficial part. That's the part that tells us what the emotions of the traders are, right? What people are feeling about this particular stock or this index, right? Whatever you're looking at. The question is, how do you feel about it? And where are you at mentally and emotionally? And you should always be in a place. One question that you should always ask yourself is, here's the amount of risk I have in this trade. If it backs up against me and goes against me, barring a gap, of course, and knowing that that's a possibility, am I comfortable with the amount of risk I'm taking? If you cannot answer that question, yes, you should not be in the trade. Or not necessarily not be in the trade. You should adjust the trade so that you can answer that question, yes. If you're getting in trades and you're putting $2,000 of risk on the line and you're freaking out because if you lose $2,000, you can't pay your rent the next month or your mortgage, that's not a good place to be. You're going to make bad emotional decisions. If you're comfortable with $500 of risk, then cut your position size by 75%. So I like to trade the analysis. Here's my analysis. Here's what the chart says. But I don't want to risk $2,000. I can't do 10 contracts, do 2 or 3. Because the goal is to keep yourself in that calm, cool, collected space. So you can make good, solid decisions no matter what the stock's doing. Make sense? All right, Brenda, here's the spiders analysis. There's really nothing to analyze. We're hitting all-time highs. There's no patterns, right? Not yet. We've got what could be the beginnings of a head and shoulders. Right? If it rolls over from here, it comes back to about 500 and then bounces back up and gives us a head, we could have a head and shoulders. I'll show you one that is doing that, though, and it's the Dow. Not here. This one doesn't matter anymore because it's gone. Played out beautifully. It's one reason I love patterns. It's not a beautiful head and shoulders, but it played out beautifully. It is still a head and shoulders there, and you see it dropped, and that's exactly what we look for. But the Dow is in the process of forming a head and shoulders, as is the Russell. This one's not quite as pretty. The Dow one's a little bit prettier. It's a little smaller. This one's a little bigger. But the SPX, which Spider, same thing. You see this looks the same. And the NASDAQ, and this is the Qs, right? There's the head and shoulders. That one didn't play out as good. But these are both still on tears, which a lot of this is a very small handful of companies, right? NVIDIA, Amazon, Google, Meta, Microsoft. The big boys are still headed north, and they make up such a huge percentage of this index that they're making highs because the big boys are driving it, right? You get to the Russell, and I've talked about this a lot. I went into it again last night in the Weekly Whispers and Patterns in the Flash. But the Russell's the small companies. The little companies are not doing that well. And there's the old Dow theory, right, between the industrials and the transports, where these should be correlated directly. Because in the old days, industrials manufactured products, transports transported them to the market, and consumers bought them. Well, if consumers aren't buying product, then the retailers aren't ordering new product, which means the products aren't getting transported to the retailer, which means the manufacturers don't need to manufacture them. You see, they're tied. Manufacture product, transport it to the market. Those two should be hand in hand. The Dow and the transports are both showing signs of weakness. The transports are actually in a bearish market right now. I mean, a bear trend over the last 3-4 months. Lower highs, lower lows. The Dow is in the process of forming a head and shoulders. And if it breaks down below 38, especially this 37, was about 37.5, breaks below that, we're officially in a downtrend then. Well, the SPX and the NASDAQ are still hitting highs. And usually all these markets will move in tandem if things are good. If there's not something brewing underneath the surface, then usually all 4 or 5 of these markets are moving in one direction. They're all in the same trend at the same time. And granted, maybe we're just in this flux part. We could just be in this place where it's like, well, we don't know what's going to happen next. But this is a red flag at least. It's a red flag that says there's a disconnect somewhere, something's not quite right. And frankly, this is what happened towards the end of 21. You had these vast differences between the 4 major markets, the SPX, the Dow, the NASDAQ, and the Russell, and they were starting to go different directions, and they weren't agreeing with each other, which said that, something's not quite right. And if you were trading back in 22, we were in a bear market. It dropped, 30%? It didn't crash, but it definitely was bear market. So, and it's starting to look and feel very similar to that situation where that's where we're at, right? So, in fact, there's I got the ETFs in here, so it updates. The Russell's down pretty solid today, actually almost 2%. Well, there you just saw it drop. The indexes don't come in real time, and this is not. Holy cow, I'm over. Sorry, Andrew. Yeah, see, there's the Russell today. This is the IWM. It's the ETF. The ETF will update. The indexes do not. Lower consumer confidence. You don't say. I mean, how can you not? How can the consumer not be, right? Yeah, I didn't see that, but yeah, that's usually not a big market mover, but it's not bad to know. So we'll see how it plays out. You know, like we talked about here, it's a flip of a coin. We don't know. That's why we analyze the best we can, just like the pitch. You don't know what pitch is coming, but you analyze the situation. What game is it? What inning is it? Who's pitching? You know, those guys go study. They study the pitchers and what kind of pitches they throw and how to hit them. So they go do all that study and figure out who the pitcher is. And then you have to look at the other situation. What inning it is, what is the outs, what is the, you know, if you're in a series, there's a lot of different things to factor in. And the better you get at analyzing that, the better you usually are because you're more prepared for the pitch that's coming. Just like analyze it, right? If you learn to recognize patterns and you learn to recognize and analyze the chart well, then you put the odds on your side. But really, the goal is to put the odds on your side and get your place to that calm, cool, collected place. And that's what risk reward will do. Scaling will as well, but risk reward is obviously what we're talking about here today. So, all right, any questions real quick? Because I got to call it a day because we are a few minutes over. It's certainly going to be interesting. Let's put it that way. The rest of this year, especially, will be interesting to see how things play out. It's always interesting. That's one thing that makes trading fun and exciting, I think. So, all righty. You're welcome. Thank you, Brenda. I appreciate that. So we will see you all in whenever we see you in the next class, wherever that is, whether it's Weekly Whispers or Patterns of Flash or here or wherever we're at. So thanks for coming to join me. Have a little fun. You'll have a great weekend. God bless. Bye-bye.